For most people, the question sounds almost childish. Of course trading is gambling, they say. You put money on a screen, prices move randomly. Sometimes you win, most of the time you lose. Isn't that exactly what gamblers do? But here is the uncomfortable truth. If trading were pure gambling, financial institutions would not exist the way they do today. Hedge funds would not survive decades. Market makers would not build billion-dollar infrastructures, and no one would be paid seven figures to manage risk for a living. So when people ask whether trading is gambling, they are often asking the wrong question. The real question is this: why does trading feel like gambling for most retail traders while functioning as a business for a small minority? To answer that, we have to strip away opinions, emotions, and motivational slogans and look directly at the mechanics underneath. Because markets don't care what you believe. They only reward structure, probability, and discipline. Most retail traders don't lose because markets are unfair. They lose because they operate without a system that separates risk from emotion. And without that separation, every decision becomes a bet, not a trade. Before we define what trading is, we must first understand what gambling actually means at a structural level. In gambling, the outcome is dominated by negative expectancy. The house controls the edge. You cannot change the rules, adjust probabilities meaningfully, or extract long-term advantage. You are entertained while being mathematically drained. Now compare that to professional trading. A professional trader does not ask, "Will this trade win?" They ask, "What is the expectancy of this setup over the next 1,000 occurrences?" That single shift in thinking already separates gambling from trading. But most retail traders never make that shift. They enter the market emotionally, chase price, react to noise, increase size after wins, revenge trade after losses, and anchor their identity to short-term outcomes. In that mental state, trading becomes gambling, not by nature, but by execution. And this is where the confusion begins, because markets allow both behaviors to exist in the same environment. Two people can place trades on the same chart at the same time in the same market, and one is gambling while the other is running a probabilistic business. The chart does not change, only the decision framework does. This is why the question, "Is trading gambling?" cannot be answered with a simple yes or no. Trading is a neutral system. Your behavior defines what it becomes. To understand that fully, we need to examine the most common mistake retail traders make, the one that quietly converts trading into gambling without them even realizing it.
Most retail traders don't consciously decide to gamble. They drift into it. The mistake usually doesn't look dramatic. It doesn't start with reckless leverage or blind all-ins. It starts quietly, with a mindset error that feels reasonable, even intelligent. They believe that analysis equals control. They think that if they add enough indicators, watch enough videos, read enough opinions, they can predict what the market will do next. And once prediction becomes the goal, every trade turns into a verdict on whether they were right or wrong. That is the exact moment trading crosses the line into gambling. Because gambling is not defined by randomness alone. It is defined by identity attachment to outcomes. When a trader enters a position believing this should work instead of this has positive expectancy, the trade stops being a business decision and becomes a psychological bet. The size feels bigger, the stop loss feels personal, the market's movement feels like judgment. This is why so many retail traders behave irrationally around losing trades. They hesitate to cut losses, not because they don't know better, but because closing the trade means admitting they were wrong. And once ego is involved, risk management collapses. At that point, probability no longer matters. A gambler does not manage downside first, they manage hope. Retail traders often do the same thing, just with charts instead of cards. You can see it clearly in how positions are sized. Most retail traders decide size based on confidence, not risk. When they feel good about a setup, they increase exposure. After a win, they push harder. After a loss, they try to get it back. This behavior has nothing to do with market structure. It has everything to do with emotional feedback loops. And those loops are deadly. In professional trading, position size is boring. It is predefined, capped, and often smaller than intuition suggests. Not because professionals lack confidence, but because they understand something retail traders usually don't. You don't need to be right often to make money. You need to be wrong safely. Retail traders invert this logic. They obsess over win rate, setups, entries, and precision, while ignoring the mathematical reality that expectancy is driven by risk control, not prediction accuracy. That inversion is the pain point, because once your survival depends on being right, you are no longer trading. You are gambling on validation, and markets punish that relentlessly. The painful irony is that most retail traders actually know this intellectually. They've heard risk management is everything countless times, but knowledge without structure does nothing. Which brings us to the turning point, the moment when trading stops being emotional exposure and starts becoming a controlled system. Not because the market changes, but because the trader does. The shift does not happen when a trader finds a better strategy. It happens when they stop asking, "How do I win?" and start asking, "How do I stay in the game long enough for probability to work?" This is the revelation most traders reach only after significant loss. Markets are not designed to reward intelligence, effort, or passion. They reward consistency under uncertainty. Once a trader truly understands this, several things change immediately. First, trades are no longer evaluated individually. A single loss stops feeling meaningful. It becomes just one data point in a long series. Emotional spikes flatten because outcomes are no longer personal events. They are statistical occurrences. Second, rules begin to matter more than opinions. Entry, exit, position sizing, and risk limits are defined before the trade exists. This removes decision-making from moments of stress where humans are provably bad at judgment. Third, the trader accepts something deeply uncomfortable. They will never know what happens next, and that acceptance is liberating because the need to predict disappears. Instead of asking where price will go, the trader asks, if price does X, I do Y. If price does Z, I exit. That is not gambling. That is conditional execution. At this point, trading begins to resemble other probabilistic professions: insurance underwriting, casino management, market making. None of these businesses care about individual outcomes. They care about distributions over time. This is also where smart money thinking becomes visible. Institutions do not trade because they are certain. They trade because they have defined asymmetry, limited downside, known exposure, acceptable variance, and enough repetition for edge to express itself. Retail traders rarely fail because they lack access to information. They fail because they refuse to accept uncertainty and pay for that refusal with capital. Once that realization lands, trading stops feeling like gambling, not because losses disappear, but because losses lose their power.
What truly separates gambling from professional trading is not intention, intelligence, or even experience. It is structure. At the structural level, gambling and trading behave very differently, even though on the surface they look almost identical. Both involve uncertainty. Both involve risk. Both involve money moving based on future outcomes. But underneath, the mechanics are not the same. In gambling, risk is external and fixed. In trading, risk is internal and adjustable. This distinction is subtle, but everything flows from it. A casino does not allow the gambler to redefine exposure. The house edge is built into the game. You can play longer, bet bigger, or bet smaller, but you cannot change expectancy. The math is sealed. In trading, expectancy is not sealed. It is constructed.
This is where most retail traders misunderstand the game. They treat setups as signals instead of distributions. They search for certainty instead of asymmetry, and because of that, they unknowingly design negative expectancy systems while believing they are improving. Let's take a concrete example. A retail trader uses a popular indicator-based strategy with a high win rate, say 65%. On paper, it looks solid. In practice, their average loss is 3 times larger than their average win. One emotional lapse, one oversized trade, one refusal to cut a loss, and the statistical advantage collapses. That is not bad luck. That is structural fragility. Professional traders think in reverse. They start with loss containment, not entry precision. They define maximum damage first, then search for scenarios where upside meaningfully exceeds downside. Win rate becomes secondary, survivability becomes primary. This is why many professionals are comfortable being wrong more than half the time. They are not paid to predict, they are paid to manage variance. Now, consider a real-world case. During the March 2020 crash, retail traders were wiped out in massive numbers. Panic selling, forced liquidations, emotional decisions. At the same time, certain funds were aggressively entering positions, not because they knew the bottom, but because volatility itself created favorable asymmetry. They scaled in slowly. They accepted further downside. They defined risk explicitly. Retail traders, on the other hand, went all in emotionally and often financially, trying to catch the bottom. Same market, same data, completely different outcomes. This is the core difference between gambling and trading. A gambler seeks a favorable outcome. A trader seeks a favorable distribution of outcomes over time. One more example makes this even clearer. Look at stop losses. Gamblers hate stop losses. They feel restrictive. They feel like admitting defeat. Many retail traders remove them, widen them, or ignore them altogether. Professionals see stop losses as non-negotiable operating costs. They do not ask whether a stop loss will be hit. They ask whether the risk taken is acceptable if it is hit. That question alone disqualifies gambling behavior. And this is where smart money thinking diverges sharply from retail thinking. Institutions assume they are wrong by default. Retail traders assume they are right until proven otherwise. That assumption shapes everything. Position sizing, time horizon, reaction to drawdowns, emotional stability, all of it stems from that single premise. This is why the same activity can feel like gambling for one person and feel almost boring for another. Boredom is a feature of professional trading. Excitement is usually a warning sign. When trading feels thrilling, something is wrong. When it feels repetitive and dull, structure is likely present. That doesn't mean emotion disappears. It means emotion no longer drives decisions. And once decisions are decoupled from emotion, trading stops being a test of luck and starts becoming a process, a slow one, an unglamorous one, but one that actually works.
At this point, the distinction should be clear. Trading only becomes gambling when structure is absent, when decisions are driven by emotion, identity, and short-term outcomes rather than rules, probability, and risk containment. So the real question is no longer whether trading is gambling. The real question is whether you are operating it like one. And that brings us to application. Not theory, not philosophy, but what actually changes behavior. The first shift is how risk is defined. Most retail traders think risk means how much money I might lose if this trade fails. That definition is incomplete. Real risk is not the dollar amount. Real risk is whether a loss destabilizes your decision-making on the next trade. If one losing trade makes you hesitate, revenge trade, increase size, or abandon your plan, then that position was oversized, regardless of the dollar value. Professional traders size positions so that losing feels boring. If a loss changes your mood, your size is too large. The second shift is how trades are evaluated. Retail traders evaluate trades individually. They ask, did this trade work? Professionals evaluate trades as part of a series. They ask, did I execute according to plan? This distinction is critical. You can execute a perfect trade and still lose money. You can execute a terrible trade and still make money. Judging yourself by outcomes trains gambling behavior. Judging yourself by process trains professionalism. This is why serious traders keep journals, not to track profits, but to track behavior, entries, exits, emotions, rule adherence. Over time, patterns emerge, and patterns are where edge actually lives. The third shift is expectation management. Retail traders secretly believe that once they figure it out, consistency will feel good, smooth, confident, rewarding. It doesn't. Professional trading feels uncomfortable because uncertainty never disappears. Drawdowns still happen, losing streaks still happen. The difference is that professionals expect them and design around them. They don't seek comfort, they seek robustness. This is also why copying strategies, signals, or systems rarely works long-term. Without understanding the underlying assumptions and risk profile, traders inherit fragility without realizing it. You cannot outsource structure, you must build it. And when you do, something interesting happens. Trading stops being exciting, stops feeling like a rush, stops feeling personal. That is not a loss. That is graduation. Because the moment trading stops feeding your ego is the moment it starts feeding your account. So, is trading gambling? For most people, yes. Not because markets are random, but because their behavior is. They trade without defined risk, without expectancy, without emotional containment, and without process discipline. In that state, charts are just a sophisticated roulette wheel. But trading does not have to be that way. It can be a slow, repetitive, probabilistic business, one where losses are planned, not feared, one where uncertainty is accepted, not fought, one where survival matters more than prediction. And the traders who make it are rarely the smartest or the most confident. They're the ones who learn to stop gambling, with money, with ego, and with hope. If this perspective resonated with you, then you already know what to do next. Step back, look at how you trade, and ask yourself one honest question. Am I managing risk, or am I managing emotion? If you want to keep exploring these ideas, the psychology beneath price, the structure beneath chaos, and the habits that separate retail behavior from professional execution, subscribe to the channel. This is what we do here. We don't chase certainty, we build resilience. Master yourself, master the markets.